Joining us live from the CME Group in Chicago is Tim Mulholland. He is managing partner of China America Capital Company. Tim says the expectations for growth and earnings are way too optimistic. And it's interesting because we're just about to talk, Tim, to Professor Jeremy Siegel. He's fairly optimistic as well. You think earnings forecasts need to be revised down?
Well, actually, you're coming into this earnings season on a little cyclical high here in the market, so I think that's always dangerous. But I think we also need to make a distinction between reported earnings and operating earnings. That's without the one-time events and so forth. But, listen, if earnings come in at $94, $95, this market is cheap. But, on the other hand, I think that the market's fueled by liquidity and ZIRP, zero interest rate policy, more than it is fundamentals. So I wouldn't get too carried away. But, I think the proof will be in the pudding as we get into the earnings season here. But watch out, because you're on a little high resistance area and an overbought condition in the market.
Let me ask you what you think about PEs, because we'll probably talk to Jeremy about this as well. And I wonder where you think that we should be priced here. You don't buy the rule of 20 at this moment, I'm going to guess.
Well, I don't know. It's relative, I guess, speaking. It depends, If earnings, if you look at earnings again on a reported basis versus the operating basis or the GAAP basis, it's a tale of two different stories. But, I think that, earnings probably are closer to the upper end of the range, really, than they are in the down because, again, you can play some games with the earnings.
Hey, Professor Siegel, I got to bring you into this. Where are you on earnings? Because I know you're more upbeat than most of the folks that are out there when it comes to the economic and the market outlook. Where are you on earnings?
On 2011 earnings?
Well, we're just going to...
Yeah, in general. I mean, 2010, 2011.
Oh, I mean, earnings are extraordinary. I mean, even if it doesn't reach $94 in 2011, the all-time record earnings is 91 in the 12 months ending June 2007, and the S&P was 1575 at that time. We can even, be at 90 or 88 with these interest rates and justify a much higher market. Much higher market.
All right, Tim, again, a rally with better volume than what we've been seeing as of late, but still, if you compare it to what we were getting a year ago, it doesn't really compare. Net, what do you make of the move that we've seen today?
Well, I mean, it's something not to be dismissed, but I think you're up against a resistance. And again, let's look at it. The retail investor is gone from the market, so I think what you really have are a lot of professionals trading. But when you get good news in this market and you got liquidity, you're going to get asset inflation. And I don't want to attribute this all to asset inflation, but I mean, it gives a lift. It's a liquidity-driven rally, and the volume's still disappointing, like you said, from a year ago. But again, I think your participants in the market are limited to what they were before.
Hey, Jeremy, it's Julie here. When we talk about quantitative easing and that being sort of, at least in the past couple of weeks, one of the driving factors behind stocks going higher, I mean, how far does the rally go before that becomes priced in and people are already sort of accounting for that scenario when they're investing?
I actually think it's been the QE speculation has been more responsible for the bond rally that we had. I actually think the long bond would be at 3% rather than 2.5%. If given the economic news we've gotten, but no one wants to be on the short side of that bond market if the Fed is going to come in. I support QE, but I think our economy will recover even if the Fed doesn't engage in quantitative easing. I think it would be a good idea. I think it would make our recovery faster and stronger, but it's not something that we can live and die with.
Now, Professor, it's Adam Johnson. Let me jump in. You made a key comment about equity valuation. You said the last time we had 91 bucks in earnings, the S&P was at 1,500, which sort of, if you connect the dots and we can get back to 90-something, then maybe we should go there too. But wait a minute. Back in 07 when we had 91, we hadn't yet gone through this, so nobody was, no one had the monkey on the shoulder. Now we got the monkey on the shoulder. Can we get over all that and actually go to 1,500 and actually believe everything's okay?
Well, risk aversion, to me, is at the highest I've ever seen it in the market. I've never seen such favorable valuations of stocks versus bonds. I've seen cheaper stocks. We've seen stocks, single-digit PE ratios. But relative to the bond market, you have to go back to the 1950s to get a similar situation. And, that was the framework that brought about a tremendous bull market in the post-war period. I see a very similar situation today. You're absolutely right. There is certainly more risk aversion. But there's something else to remember. That $91 that was in 2007, a lot of that was overinflated financial firm earnings. They're out of the picture now. I mean, they're one of the smaller segments from being the largest segment. So we don't have puffed up earnings in there. And in terms of reported and operating, actually, the GAAP earnings are closer to the operating earnings over the last 4 quarters than we've had on average over the last 20 years. They're good quality earnings that we've seen. So I think that the earnings picture is very persuasive going forward for the long investor.
Professor Siegel, I got to ask you, because you were talking about this with Julie about QE2. I mean, all the moves that are being made by governments around the world, are we setting up for trouble? Because you said, we're going to be okay whether or not we have QE2. Are we, by potentially doing QE2, setting up for some significant trouble down the road?
Well, the main thing a central bank's supposed to look at is inflation. Bernanke said that inflation was running below what the levels that they thought it should be. Mm-hmm. So as a result, as long as we don't see heated up commodity markets, I think that excited commodity markets, and I am a little worried about gold and oil and all those moving up. But as long as the data on inflation isn't excessive, I think that we can have quantitative easing.
No, do you know what? We'll let him put his earpiece back in, and
Professor
but I want to get Tim's take on inflation as well, because Tim, I wonder what you think about this. The Fed sees not enough inflation, but a lot of people in the middle of the country, Chicago I'm sure as well, are feeling real inflation. How high does it go, and does the Fed let it get out of control before they jump on it and make a move?
Well, there's a little bit of an interesting argument on, right now, obviously, deflation is what the bond market is saying that the risk is. But when you take a look at the real cost of living, I guess I look at inflation 2 different ways: reduced purchasing power or higher prices. And I think that over the past 5 years, 10 years, we can, basically people can say your purchasing power has been severely reduced. So I don't really buy the deflationary argument, but I do think this experiment with quantitative easing and zero interest rates, should it backfire and should we get some inflation, there's a real problem on the Fed's hands at that point. But for right now, I guess you take what it is, and it's, I don't think you have deflation, disinflation, but I think look at how it's calculated and the quality of how inflation is being reported as well. And as far as cost of living or rising prices, take your poison.
Hey, Professor Siegel, it's Dominic here. One of the things that you talked about before was this idea of, the $94 in earnings per share in the S&P 500, but that's a stark contrast to where strategists are saying earnings could come in. They're saying closer to $87 a share. Why the disconnect? Why do those people who look at macro themes like strategists say that earnings are not going to be as good as you think they are from the analyst perspective?
Well, first of all, top-down earnings, you're perfectly right. Top-down earnings are almost always lower than the bottoms-up earnings. And that's what the analysts do. The bottoms-up earnings adding up to 500 firms, and they're usually 5-10% higher. The truth sometimes comes in between the two of these. But even if we have 87 earnings, we're looking at a market of 12, 13 with an interest rate of 2.5% on the long bond. I mean, that's a favorable valuation ratio that you can't ignore in the market. Back 3 years ago, when our market was at 15.75, we had the long bond at 5%. And a lot of those earnings were overinflated because of the financials. These are much more sound earnings with an interest rate of 2.5% and moving up instead of moving down.
Hey, Jeremy and Tim, only about 30 seconds here left, but I want to ask you, Professor Siegel, how much more do we have to go in this rally, and where do you think we're going to be at year's end? We're up now 4% year to date on the S&P.
I think we're going over 12%. I think we can easily get one of the best fourth quarters that we have. And I can see ourselves being up 10% by the end of this year.
Tim, what do you think about that?
Just quickly.
Well, I think you're in a range. I mean, we've been up and down a range of about 10.25 in the S&P to these levels, several times in the past few months. So I think you're still in a range trade. There's still a lot yet to be proved in the market. And I do question the quality of earnings going forward. And if I'm wrong, we'll see.
All right, got it. Hey, Professor Siegel, thank you so much. Tim Mulholland, our thanks to you as well.